Hey there. Are you sick of shills? Are you sick of fake hype? Are you sick of getting roped along by individuals who know absolutely nothing about the situation we are all currently in? Well, coming from someone who has actually looked into what's going on and not relying on dissemination pieces for their content, I'm once again not here to tell you anything. I'm here to show you something. What I want you to do is this. If your head is jumbled up with a bunch of information and a bunch of different ideas of what could be going on, this is the crux of the problem. This is purposely done by the media, and then is presented to the content creators that are all a part of this neural network, who then have a choice to either accept or deny the material. If accepted, the material is then disseminated to their groups, which then spurs discussion, which then creates confirmation bias because others are like-minded about the topic, and then before you know it, a resistance network is formed and the false information becomes ingrained in the group. You see, social media is much like a blockchain network. The core flaw of blockchain is scalability. The same thing could be said about social media when it comes to influence. If you think about content creators' influence, especially in this situation, we saw the influence of many creators early on skyrocket so fast that they didn't have enough time to verify the information they were being told. This is exactly what Ryan Cohen's tweet meant about proof of work. This means that if the blockchain supply, or influence, is scaled too quickly, the influence would then become gamed by the biggest players, which is exactly what we see happening here. Doing the work and building a verified trust network is something that even the CEO of Ethereum said is essential to blockchain projects. And by the way, no, I'm not copying Carlos' trades. Anyone can use a text-to-speech voice. I just feel a little ill at the moment and sound even more retarded than usual. Sue me, right Lou? Ha 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 ha. Just kidding, big guy. The point is, all of this noise, all of this hype, it's all meant to distract you from what I'm about to show you. GameStop wants NFT creators for their marketplace. Another thing to note is that Layer 2 Ethereum will not be completed until sometime this year, and that's if there is no setbacks. So for anyone to think most can happen before Layer 2 Ethereum is ready and before GameStop is ready to launch their NFT marketplace is likely just another example of a product of the deceptive content. This is the repo market. Everyone thinks they know how it works, but they all don't want to look at the data and all don't want to read the policy. They just listen to the Fed minutes and go on about their day. Let me show you where the true weakness of this entire operation is located. That would be the only non-moving part of this ecosystem. The non-cash collateral, only utilized for haircut purposes or hedging changes. 5% of repo demand is considered non-cash collateral, which is comprised of other repurchases including equity securities. This can be verified by a public release from the SEC that came out the same day the first trial hearing was held when Keith Gill testified. Throughout the year, we also know that there is such a thing as custom ETF baskets which are used to create and redeem securities based on similar composition, and then they use these securities to pledge as collateral in the repo market and securities lending market, which essentially are the same thing when it comes to how they are conducted. Now, we're going to go back to our repo diagram and I'm going to show you why this strategy works. So we know that securities lenders, which are pension funds and insurance companies, are all stacked into AMC and basically many other stocks in the entire market. Remember what situation we were in last year at this time? GameStop had almost 200% institutional ownership around this time, and that was never discussed in the SEC report. However, if you look at their institutional ownership today, it's only 30%. Why is that? Well, they're keeping the market propped up with everything but meme stocks through what's called collateral chains. This is what they don't want you to see. This batch query contains over 800 companies with over 88% institutional ownership. Do you see it now, Mr. Krabs? Because if you saw it, you'd realize that you can easily trade off of these securities as they are set up algorithmically. This is what I've spent my time trying to figure out. How to attack the repo counterparties. Their non-cash collateral is immobilized, and can be exploited. How the tables have turned, ha head fucks.